You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA, and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means we are back once again. A rare live treat. Yes, it is time for another live edition of Options Playbook Radio, what the cool kids call OPR around these fun parts. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Where do you go if you want to join us live for this huddle, for everything else we do throughout the week, get all the pro content we're giving you? We just did 2 additional pro Q&As for you folks. Just got off one about an hour ago with the Mr. Don Schlesinger himself, the short ball and blackjack Hall of Famer out there. So he's a fun one. So those are all hitting the feed as we speak. Where do you go to get access to all that content, the live huddles, everything else we do here, the giveaways coming up on the June Pro Trading Crate giveaway? You know where to go. Theoptionsinsider.com/pro is the place to go to learn more. And before you say to yourself, hey, wait, that's not the usual guy on this show, you are correct. Allow me to introduce your usual host here, the options guy himself, a.k.a. Mr. Brian Overby, the senior options analyst over there at Ally Invest. Mr. Overby, welcome back to your own show. What a pleasure it is to actually see you while we're doing this, sir.
Yes, this is a lot of fun, Mark. I'm actually doing it from the Ally Invest office. I don't always come in. So it's exciting to be able to get together and huddle up and answer some of these listener questions. So let's do it. Let's huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, welcome to the Huddle, the portion of the show where Brian and I unite forces like Voltron to try to tackle your tough options questions. And let's see what you guys have on the docket for us this week. Actually, before we get to that really quickly, let's pay off a fun question of the week that we just asked you guys last week. A lot of you folks have the market levels on the brain. It's hard to blame you. It's kind of the story right now. How low can the S&P go? Well, we asked you guys a couple of weeks ago, what were you up to in the market? Over 40% of you said you were waiting until you were BTFDing, but you were waiting until the SPX hit that next level of around 3750 before you were starting to kick in and actually nibble in the market. So last week, of course, we hit that level, broke through it, and we asked you, hey, what are you guys up to now? Are you starting to BTFD or are you waiting for lower levels? We actually gave you 3 choices. So you're waiting for lower levels, or you're back in, you're buying both hands, buying this market again, or I never got out. I don't like that one, but unfortunately we had to put that in there as well. The results, Brian, were kind of interesting. 54.2% of the audience said they're waiting, they're hanging out for lower levels, so they're not buying in at that 37.5 level, even though we're not quite there yet again, but we're starting to threaten it again. What dismayed me, Brian, 25.4% say they never got out. So that's a little alarming. You know, listening to the network, listening to shows like this, we're coming off the hottest month in the history of the network 15 plus year history. Never had more people listening to the network than last month. So people are listening, but they rode the elevator up and they're riding it right back down, Brian. So that's a little bit concerning. And then 20% saying you're back in, you're jumping in with both hands. So intriguing stuff. What do you think about that poll, Brian? And then we have a related question. We'll throw this in here as well from Alan. Alan wants to know, what does Brian think about the current market sell-off? Does he think it has more legs? So I guess what Alan is asking is, are you with 54% of our audience, Brian, who are holding out for lower levels?
Well, if I'm looking at the lower levels, and specifically if I toss in Alan's question here, well, actually, that's Jason's is the next one. I'm sorry. The 3,300 level, a lot of technical analysis people have said, well, that, that's the next level. That's the next stopping point in the S&P 500 index. Yeah. Could it go lower? Yeah. Yes. There's still a lot of good that's happening in the marketplace. We have low unemployment still. It's not quite starting to creep up. The consumer is strong. We're still seeing spending. I actually had some decent housing numbers this week. So not all the stuff has hit the fan just yet. And maybe we can get that bounce. But one of the things that we never had, and we've talked about a lot, I know we did the volatility views on Options Insider. I was able to join on that. Is the fact that we just haven't ever seen that big run up in the VIX followed by a big down move in the marketplace. We're just slowly heading to new lows. So it's hard to guess exactly where we would stop. I would feel a little bit better if we had that moment where the VIX shot up to 45.50 and we had a 4% down day in the S&P 500 index. That would actually make me feel a little bit more comfortable about it. But trying to guess exactly where the bottom is, that's a little tough. Now, right now, if you're listening to this live, you're not going to be aware of this, but I've been looking at strategies as part of the educational stuff that I'm doing here at Ally Invest that are bottom picking, like selling some put options on stocks I wouldn't mind buying, trying to pick a little bit of the bottoms. We're officially in a bear market now, so I wouldn't mind allocating some of the capital at this point in time on strong recession-resistant type stocks that I wouldn't mind owning if they go a little bit lower. So that's kind of the option strategy that I've been thinking about. Cash secured put selling put spreads on a little bit more volatile stock. So I can't say, well, this is the bottom. And, that would, first of all, my compliance department wouldn't like me to say that this is the moment right now. But if I am allocating capital, that's the way I would be doing it, using options.
That's what we're all about, Brian, allocating the capital using options. Since you're talking about nibbling, starting to get in at lower levels, taking advantage of that put premium, that leads nicely into our next question here from Jason. He says, does Brian prefer to sell cash secured puts or put spreads in SPY at this level? I'm thinking of level. Oh, he's talking about the level you're just talking about. I'm thinking of levels around 330 in SPY, so obviously 3,300 SPX. Brian, you're starting to nibble here. Are you looking at the straight cash secured put? Are you going more put spread? What's your poison, sir?
Well, and I brought up the 33 level. I saw that question by Jason, but that's been mentioned, 330 level in the SPY. That's been mentioned by a lot of technical analysis people. There just seems to be a little bit of support right there if you look at the chart. So they're saying that if it did come down to that level, that hopefully the market would get some support there. So you're getting some premium at those levels. So I don't mind selling those puts, and I don't mind selling them if you're willing to buy the underlying stock. I don't want to just sell them naked. As opposed to selling them naked, I would rather do the put spread. But if I'm literally thinking that this is the level that I wouldn't mind getting along the SPY, it goes right along with what we just said on the previous question. That level, if you're selling it, well, the technical analysis people seem to think that is a level where you may find some support. So why not? Right? That simple.
Yeah, I don't hate these either. I mean, as long as people are aware, obviously they think they can sell a put, they get whatever 2%, 1%, 3%, whatever the level is they're going to get for that put. And they go, oh, that's just free money. There is, especially if you're going the cash secured route, there is an opportunity cost to that. They're going to tie up effectively the amount of capital you're going to need to buy the stock at that level. So as long as you're okay tying up that capital, don't sell that put and then come in the next day and say, wait, where did all my option buying power go? A lot of it's going to be tied up in that trade. So as long as you're okay with that, if you don't want that tied up, or perhaps you're concerned about the market blowing through your strike and then maybe you're going to have a change of heart. I don't want the S&P at 3,300 anymore. I want it at 3,000, whatever the case may be. Then perhaps the put spread is the better way to go. So there are benefits, there's pros and cons to each. It's up to you kind of what you're looking to do. But if you're looking to establish a long position, you could do worse, I should say, really, than selling some cash secured puts at that level. I don't mind 3,300. I think a lot of people would take that right now, given where we are at the S&P. Let's go out to this one from Mark. Nice name, Mark. Mark McGee. He says, I'm trying to learn more about calendars. They're pretty tricky. Yeah, you're right. They are pretty tricky. He says, so far, I think I can handle the use case for a basic long calendar, but I've heard people talk about diagonals as well. When do you decide to make the switch between straight calendars and diagonals? Brian, I know how you talk about calendars in your Options Playbook Radio and your educational content over there at Ally. I've often referred to calendars as kind of the options 201 or maybe even the 301. So once you start learning, you buy an option, then you start trading verticals and other things, then you start effectively graduating to calendars. It seems like the notion of those two offsetting positions in two different expiration months, it kind of blows a lot of people's minds. They can't think about, wait a minute, I'm long here, but I'm short there. What do I want to happen? These are two offsetting but weird contrasting positions. And then you add in the next level, you go to diagonals, and people even get more confused. So I'm curious for you, Brian, where do you draw that line of demarcation? Where is your Mason-Dixon line between straight calendars and diagonals?
Well, see, that's a real tough question if you ask exactly that, a straight calendar or a diagonal, because it really depends on the underlying. It depends on the volatility of that underlying that you're trading. So I don't really have a rule of thumb. I'm just looking at if I'm doing this trade and I can do it as a diagonal where I'm selling, on the call side, I'm selling something that's a little closer to the money, and then I'm going a little bit farther out, and maybe I can get it done for a credit. Maybe then I would consider a diagonal. But you got to realize that if you're selling the strike that is the lower strike on a call, like I'm selling the 50, buying the 55, well, I'm going to have a requirement too. So it's very possible, and this is why it gets so confusing, to do a diagonal trade and pay a net debit for it and still have a margin requirement, right? Because it's considered, as far as the brokerage firm is concerned, it would be very similar to doing a short call spread in this little scenario that I just painted. So very tough to make that move, because you have to really think hard about, do I have a margin requirement if I do this? Even if I pay a net debit to the account, I may have a margin requirement. So it does get a lot more complex once you go into the road of diagonals. Now, on long calendars, one of the things that you really need to think about, Mark, when you're doing these trades is that if I am long a calendar, I'm literally long implied volatility. And that's how I think Mark was kind of referencing this a little bit, in that if I'm doing this and you do a long calendar, this is the best way I've always been able to explain this. I ask this question in a lot of seminars, and about half the room gets it right and about half the room gets it wrong. But if I do a long calendar, what you want is you want that short-term option. You want time decay in it. You want implied volatilities to come down on the short term. You want it to whittle away. You're usually doing an out-of-the-money option contract. But on the long-term option, you want implied volatilities to increase. You want to get intrinsic value, if you will, when it's all said and done. So as expiration approaches, and let's say you are correct on your forecast and the short-term option goes away, you would rather have implied volatilities higher, because effectively, when the trade's all said and done, you're going to be long a option contract at the end of the trade, at the end of the first expiration. So with that said, I've looked at calendars. Even if I'm doing a calendar or a diagonal, I like to think about them around earnings, where I'm buying the month that contains earnings, that actually expires after the earnings, hoping to get a bump up in implied volatility, where on the short-term option contract, we're hoping that volatility will come in. So that is one scenario where I can kind of foresee what may happen with implied volatility. And I'm using a lot of trepidatious words here. What may happen in implied volatility, because usually as earnings approaches, the implied volatility of that expiration will continue to go up, and the implied volatility of the one that does not contain it has this tendency to go down. So I want to think about that if I'm doing calendars, more so than should I do a diagonal or should I do a calendar? I want to be in a solid situation to put that trade on.
I'm surprised you didn't mention my favorite example of a diagonal, Brian, which is the one I often refer to, which is your favorite, which is the fig leaf, right? That's kind of one of the best, easiest examples of a diagonal for people to wrap their heads around, I think, the stock substitution example.
Yes. And I don't disagree with that. I didn't think we were going down that road a little bit.
Oh, we're going there. About it. Buckle up. We're going there.
When I'm thinking about a calendar versus a diagonal. But yeah, that's the most, I think of that more as an alternative to a covered call as opposed to a calendar, if you will, if you give me that leniency. So I guess that's the way that I went.
Yeah. People are having trouble rationalizing the differences between the two. I always kind of start them with the fig leaf. Hey, you get this, you get what stock is,
right?
You get the stock substitution leg of this, and now we're just adding an income component to that, and that seems to be a little bit less intimidating than, hey, wait a minute, you got all these moving parts, all these different moving expirations. Look at the term structure, all these other things that you really need to analyze when you're looking at a calendar. But who was that? That was Mark. Good question there, Mark. It is a tricky subject. We probably can do many episodes on calendars, and we have, and Brian has a lot of content there on Options Playbook, optionsplaybook.com as well. You can always check it out and go back into the archives if you've missed some. There are many episodes about calendars, and indeed the aforementioned fig leaf. Looks like the live chat is having fun, Brian. Nichols says, this is fun. I wish Brian would do more live Playbook radio episodes. So there you go. We're getting more requests from the live chat, Brian, for you to come on live. I know you're doing a lot of live stuff at Ally over there a lot right now, right?
Yeah, we do. On Tuesdays, every Tuesday, we do a stock play of the day. It's fairly similar to the podcast, but we do it, obviously on YouTube. So we have a live video, and you can actually interact via the chat box.
It's obviously not as good as the podcast, but it's like the podcast. I see what you're saying. Yes. Yeah.
Fair enough.
So Nichols, you guys out there, don't be shy. You don't get to have Brian live on the network too often. So if you have live questions, hit him up. We'll try to bump you guys to the top of the list. Let's keep on rolling here. Let's go to Andrew. Andrew wants to know, we've seen extreme volatility across all markets, including commodities. Does Brian watch the commodity space? And what are his thoughts on the levels of volatility exhibited there? Thank you for answering my question. Well, you're welcome, Andrew. We always answer you polite folks. You're all very polite there. Brian, I know do you watch a lot of the commodity space? And if so, Andrew wants to know, what are your thoughts on the insane vol we've been seeing out there lately?
Well, the thing, I guess I wouldn't call it insane. I think volatility is acting very cordially, if you will. We are seeing, obviously, you got to change in oil, but you have a war going on. You have Russia invading Ukraine, and that is obviously going to make some of the volatility in this space, and it's going to add to the commodities. You have the shutdown in China. So I don't think that it's necessarily insane. I think it's a relatively tame. We've talked a lot about the VIX index and the fact that during this period, it's averaged right around a 25% range. We never had the big break past the 40 mark, and we just haven't had that panic type moment. So my thoughts on it is that, yeah, there is some volatility, but man, it could be a lot worse, I guess, is the way I'm looking at it.
Well, it does make sense. We're seeing a lot of vol. We were just talking about it on our pro Q&A just a few hours ago, and they have some interesting realized volatility metrics that they put out, including on a lot of commodities. And some of these commodities, Brian, were at literally 100th percentile. They had never been higher from a realized vol perspective. So when you look at it from that standpoint, it certainly is interesting times, to put it mildly, out there in the commodity space. Speaking of volatility, let's go to this one. Brian, these are your two favorite products on the planet. Meets is asking about, has Brian dabbled in SVIX or UVIX since the last huddle? Any updated thoughts on these? I'm going to guess the answer is no, but maybe you're going to surprise me, Brian. Are you loving now? Are you dabbling in SVIX, which is, of course, the inverse VIX product, and UVIX, which is the 2x levered VIX product?
No, my answer would be lie down until the urge goes away. I looked at them when they first came out, And it's just when you see the correlation between the VIX and what these actual indexes do, they're just, gosh, it's almost like they're too completely like the fact they got VIX in the title doesn't do it justice, right? To the VIX. It's an insult to the VIX because they just don't do what you're expecting to do. So then you're just completely guessing. I would rather trade options on the weather, period, than trying to figure this out. So I just stay away from them. That simple.
I had a feeling that was going to be your answer, but I'm always open to surprises, Brian, here on the network. I haven't personally dabbled in either of them either. I like to look at the options, and the options aren't quite there yet. They're still kind of, I think the ADV for SVIX is somewhere around 600 or 700 contracts. So not UVIX doing a lot more, around 3,000, but still a lot more is relative compared to SVIX. Neither of them are blowing the doors off yet. So when they get there, perhaps I will start dabbling. I haven't dabbled in the underlying either because, again, mostly like to trade in the options out here. Oh, looks like the chat is warming up now, Brian. They're starting to feel their oats. They got questions for you now. Let's go out to Options Queen. Right. Options Queen wants to know, where is it? Here we go. Can Brian mention some of the names that he's been talking about in his bottom fishing put spread examples at Ally lately? You've been talking about selling, put spreads and using that and puts to bottom fish. What are some of the names you've been looking at?
That's really funny because I actually mentioned all of those in the podcast, which is going to come out tomorrow, but I can mention them here live. The one we just recently did in Options Playbook Radio was Ollies. OLLI is the symbol. And that had a little bit to do with what went on with inventories, the Target news that they got inventories wrong and that they're going to be wholesaling some of their big ticket items. Ollies is a bargain outletter that is actually very popular in the Carolinas where I live, and they have cash on hand and they like to buy up those inventories, and they do very well when the big retailers get it wrong. So we were doing a little bottom fishing with a short put spread there. We talked about Amazon mainly because it's split and it's now a $109 stock and it's fairly feasible to buy 100 shares of it. So we looked at Amazon, trying to do a little bottom fishing in that. On Stock Play of the Day over on the Ally YouTube channel. Talked a little bit about Pfizer and the fact that it's trading between 9 and 10 times earnings right now. And it's just a solid company trading at very low PE. And, which ones do you want? Ollies is a Dollar General, Ollies. Those are companies that usually do fairly well in recession. Pharmaceuticals are usually a little recession proof. None of these are recommendations. What I'm really trying to say is look for stocks, and I guess let's just put it in general. I'm looking for stocks that are fairly strong fundamentally, that are a little bit recession proof, and we're trying to pick bottoms. SPY, we talked about it on the show. Maybe selling that to try to pick a bottom in the S&P 500 index. It's just, we're in a bear market now. And if you want to bottom fish, options allow it. So for the first time in years, I've been leaning towards strategies more like put selling and, put spreads, short put spreads. I don't know why I struggled with that so much. Only because we have higher implied volatilities, and these are strategies that fit the times. And that's what Options Playbook Radio is actually all about. It's all about looking at strategies that meet the market condition as opposed to just trying to pick the perfect underlying. And that's where it all comes from.
There we go. Let's keep on rolling here. Oh, let's go back. You just mentioned Amazon. We got another question in the chat. Frank1209 wants to know, does Brian see any more options activity in Amazon at Ally now that it has split? I think I know the answer to this one too, Brian, but what are you seeing over there at Ally?
Yeah, well, it was a big production. Actually, we were, worried that after the split, we had to get all the shares in people's accounts before the opening. We did it fairly successfully. As far as I know, I didn't hear about any big concerns in that regard, but that was an issue. And yeah, we are seeing more activity, and you're going to, because A 20 share lot in Amazon was a big deal, and now that's 2,000 shares. So just it's hard to decipher exactly how much of it, but Amazon is one of the biggest holdings, and especially if you look at options, the FANG stocks drive a lot of the option volume at any brokerage firm, and it's not necessarily, and I just want to make this clear, that it's not necessarily because the people want to own the FANGs. It's the liquidity factor. If you're trading options, you want to trade in very liquid underlyings just so that you have decent option markets. So Ollie's was a tough one for me. I actually addressed it in the podcast because even though the stock was interesting, I would only probably do a short put spread in Ollie's. I don't think I would buy a long call spread as opposed, to get bullish, mainly because of the liquidity factor and all the dynamics that are involved with expiration and everything in a short put spread as opposed to a long call spread. And it's because the liquidity just isn't there. It's not as liquid as even a Target or a Walmart, which we were talking about on that podcast too. So it has a lot to do with liquidity. And yes, Amazon has picked up, and the splits are, for clients like ours, which are a lot more retail than institutional, splits are a good thing. That's simple.
It's the magic button, right? You flip it and all of a sudden all the volume explodes. We've seen Amazon. Amazon used to make our top 10 every now and then, maybe once a week or so. And now it's there every day. If it's not number one, it's number 2 or number 3. It's just blowing the doors off from a volume perspective. I got to imagine for brokers like you guys, it's a fun time. You wish everybody could split. All right, let's go. Right. Let's go out to Ashley. Ashley Wright says, on an Iron Condor, is it possible to take profits and close positions before expiration? Well, short answer, Ashley, is yes. You can do that with just about any options trade that you can think of. I don't know why an Iron Condor is sticking out in your mind as perhaps being the exception. Brian, do you know why perhaps she's confused, why she can't close out an Iron Condor and take profits before expiration?
Well, it might be the fact, do you want to? Maybe we change the question a little bit. Do you like to take profits before expirations? And my answer in that would be yes. Anytime I'm doing something like an Iron Condor, where the market can move in either direction, and I see an opportunity, let's say I did a 5-point wide Iron Condor. So I'm short a 5-point wide call spread, and I'm short a 5-point wide put spread. If I did that in one of those trades, one of the spreads is trading for, let's say, 10, 15 cents. Yeah, I'm going to close it out. And I prefer to do it that way when I'm looking at an Iron Condor. If one of the markets is going against me, but I can literally close out that risk on that opposite side and then let the other side run or roll it or adjust it. Yeah, I'm more than not, I would take that risk off the table and then just be in one of the short put spreads. So I guess I'll answer it that way, Ashley. But yeah, you can definitely close out the position. All you do is just the exact opposite. Everything on all 4 of the legs, if you want to close it all as one, you're just going to have 4 closing trades in your account as you send that order to the floor.
To the floor, the good old days.
Yeah, I caught that. I saw it. It's funny that you caught that too. As soon as I said it, I'm like, yeah, that just dated myself, saying to the floor.
I like it. Good old days. I like it. All right, let's go out to, this is an interesting one from John. John says, why do you think ChargePoint, ticker symbol CHPT, does so much crazy options volume? Do you guys plan to cover it more on Options Oddities? Well, the answer to the latter portion is yes. I've joked about it on that show a number of times that we could do a whole hour on the kind of just insane stuff that goes up out there. I'm looking at it today, and it did 83,000. This is this is not a big name. This is an electric vehicle infrastructure play, effectively, listeners. The ticker symbol CHPT, trading $13.86 right now. It has a nearly $5 billion market cap, so it's not nothing, but we're not talking Tesla or Amazon here. And yet the paper you see going up here is analogous to what we see going up on those. Even on a quiet, slow day, you'll see 35,000 lots and 20,000 lots. I'm looking today, 83,000 contracts going up. We had 20,000 of the the July 13 puts, 20,000 of the 11 puts, and 16,000 of the 15.5 calls. And this thing just prints volume, and it's two-sided papers. People loading up on calls, loading up on puts. It's almost like a couple of funds have gotten together and they're just playing a tug of war. They're battling each other out here in Charge Point. So the answer to the latter portion is yes. Probably we'll talk about it more. It's just there's so much you can almost do it literally every day, and some of it is borderline nonsensical. You got to really sit down and say, what the hell are they up to out here? How do they make money with this trade? But it's fun. And it's good fodder for a show like Oddities. I'm guessing maybe this Friday, maybe we'll get some when we have Assad from Shift Search joining us. Brian, do you guys see a lot of Charge Point paper over there at Ally? And what are your thoughts on John? He wants to know why we think it does so much crazy options.
Liquidity behooves liquidity, I think. If you get some liquidity going into the marketplace, the stock is moving. So sometimes when you get that type of liquidity, it will draw in more liquidity. I don't have that's like a punt answer because I don't have a really good answer for it. But yeah, I don't know why.
Might be a good one for a future OPR episode, Brian. It does a lot of paper. I mean, it might be worth looking at just for a fun speculative episode.
All right.
I'm twisting your arm.
I'd probably look at something more like a long straddle or a strangle or something like that.
That would certainly work too. This thing's putting up 50,000 lots, so they could handle
where's
it.
Where's the vol at right now, Mark? I don't have the chain up.
I don't have the chain. I was looking at it here. Let me see.
Okay.
I can pull it up and let me see if I can get the.
I'll get it. That's no problem. Go ahead. We'll go on to the next one, and I'll.
Data here. There we go. 87.5 right now, Brian. It is in the 80th percentile.
Yeah, I mean that's not outrageous for the way the stock has moved. I mean it's done more than 100% to the downside, right? It was trading up around 45, 50, so it's made that 80% move to the downside.
Both the 30 and 60-day historical vols are both in triple digits, so they're putting up some numbers out there from a vol perspective.
Right. So the vol's gotten it wrong. If you think of it that way. Yeah. Right. So the long straddle would have been the play. Not saying that you obviously don't know the direction. So if, stock was trading at 80 vol and say stock's around 30, 35 or 30, I'm looking at some of those little bounce ups. The buying long vol would have been better than selling it.
In this case, yeah. Sometimes when vol gets high, that's a good time to buy. It's counterintuitive, but it does make sense. All right, Brian, we'll get you out of here on this one. This is from a fun one from Albert Adams, kind of a silly one. Says, is it still called stock substitution when you're doing it on an option on a future? So I guess he's saying when you're using futures options, is it still called stock substitution, Brian?
What's the sound of one hand clapping? Yeah, I guess so. I mean, I think I can use that name. Why can't I say stock substitution? That's fine, but it's future substitution. Yeah, what do you think, Mark? I'm going to punt.
You're punting a lot today. You've been working on your punting skills.
Well, I'm getting ready for football season.
I think underlying substitution works. You can't get hung up on stock. Nomenclature, you can't get too hung up on that stuff. But you're right. It is not a stock. If you're buying, let's say, gold, you're doing a stock substitution. I even said it just there. An underlying substitution on, let's say, gold futures or crude oil or nat gas. Clearly, there is no stock involved, so it does require a little bit of a name switch. You could go with futures substitution. We wouldn't hold it against you.
I like the term you use there, Mark. Underlying substitution.
Yeah, that covers everything, right?
There you go.
There we go. Right. It covers everything.
Security substitution.
Oh, there we go. Now we're
getting
splitting hairs.
Yeah.
Before we get too nutty, listeners, that music means we have come to the end of another fun live huddle. I want to thank everybody out there for joining us. The chat's thanking you, Brian, so they had fun. If you want to join the chat, you want to ask questions to Brian on the rare occasions that we wrestle him live onto the network, or indeed all the other shows that we do live here, or get, of course, our exclusive pro Q&As and options oddities and our giveaways. You know where to go. TheOptionsInsider.com/pro, or for you really cool kids, you can go to /secret club. Just don't tell anybody. That's just between me and you. That last URL there, Brian. And Brian, where should they go if they want to see more of your content, or perhaps put up and check out some of the stuff you put up on Options Playbook in the past?
Well, the easiest thing to do is just follow me on Twitter, because whenever we have a major event, I'm always going to be tweeting about it. My handle is simple. It's at my name, at Brian Overby. And then you can always just send me an email if you have any questions. My email is theoptionsguy at invest.ally.com. Thanks for listening, Mark. Thanks for hosting today. And we'll see you next week on Options Playbook Radio. May all the options that you buy finish in the money, and all the ones you sell finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.